Let's talk more about the markets now with Kara Murphy, Chief Investment Officer at Kestra Investment Management. Kara, great to have you with us. You know, what's interesting about the markets is the markets have come around to the higher notion of the higher for longer part, and they've done it in stride. I mean, defending 4,000 in the face of 4% on the 10-year yield seems to be really strong.
I think there's a little bit of a disconnect here where the fixed income markets seem to have accepted this higher for longer narrative from the Fed, but stocks are still sort of questioning it. You know, the rally that we had earlier this year was largely driven by low quality stocks. And then all of a sudden we had this, stronger retail sales data, better jobs data, and stocks just kind of continue to go up. We've had a little bit of a pause here, but it's still, we haven't round tripped that, sort of low quality rally that we've had so far this year. So I think stocks are still not fully digesting that more aggressive Fed line.
In terms of what you like and you don't like, right now you're staying away from commodities. So you don't think, for instance, that oil will get a revival from the China reopening?
So we had positions in commodities, energy last year, the first half of the year. It was a very effective inflation hedge, but we started to take those off in the second half of the year on the idea that inflation was starting to subside. And we think that they work really well in inflationary environments, but when you don't have inflation, they have a very spotty track record. So, there is an argument to be made that energy could catch a bid with China reopening. But if we're right and we see slower economies in the US and Europe, I think that'll offset some of that additional demand. And so it's harder to make that call on energy from here.
Let's say you have money to put to work right now in the markets, Kara. Would you recommend buying the S&P ETF or a 2-year Treasury note?
Ooh, so that's a difficult... Okay, I think I would probably go for the 2-year Treasury yield. You get a really nice yields that you can count on. The S&P, as I said, I feel like still has gotten a little bit ahead of itself. So in the very near term, I think we're likely to see some weakness. So from here, if you're going to force me to make a choice, it's going to be the Treasury.
This goes to the notion that credit sometimes, like we're seeing yields here that are very attractive in general, right? Versus the risk rewards in equity.
This is the first time in years that we've been able to talk about cash as a real alternative. All of a sudden, we're hearing investors say like, well, I could just earn 5% in my cash. So it's a very different kind of scenario than we've been used to over the last few years. What that also means is that we're seeing a lot of opportunities in general in fixed income, and there's still a lot of fear in those markets. So I think you can find some really interesting opportunities.